This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com.
Back in Chapter 2, when we were introduced to the income tax computation, we saw that there were two main sources of earned income. Earned income, of course, being in reality the main source of income, if not the only source of income that taxpayers will have. Now, those two main sources of earned income were either from self-employment, and we have devoted some 5 chapters, of course, the previous 5 chapters from Chapter 4 through to Chapter 8, looking at the issues that pertain to the assessment, the taxation of the self-employed. We've now thankfully got just one chapter in which to deal with employees and employment income, but it's a fairly sizable chapter and a most important one. We can guarantee now, given the new style of examination with the extra involvement of objective testing questions, that somewhere, for several marks no doubt, issues pertaining to employment income will indeed be assessed on you in your examination. First thing we've got to do is to differentiate between those who are assessed as employees and their remuneration is dealt with under the employment income rules, from what we've been looking at, as we said in the previous 5 chapters, from those who are self-employed. As you can see here in Note 1, basic points made. An employee, quite obviously, is going to be assessed using the employment income rules that we see within this chapter, whereas anyone who is deemed to be self-employed is taxed, of course, under those trading income rules that again have taken up so much of our time so far in our studies. But how do we differentiate in terms of someone who is either an employee or self-employed? Right, that test. The following principles here in section 2.1 should be taken into account in deciding between whether a person is indeed an employee or self-employed. And it comes down to a determination that's based on very precise wording. And that is whether or not the work that someone does is under a contract of service, and a contract of service would make the taxpayer an employee, compared with whether the work being done was a contract for the services performed, which of course is dealing with the self-employed. Now, there may not be any specific contract of service, but what we must then look at is the reality behind the work being done. And we have these various tests that will determine whether indeed we construe a taxpayer to be an employee of an employer, or indeed genuinely to be self-employed. Now, you might wonder, why does it matter? Well, as we'll see, taxpayers may indeed wish to be treated as self-employed rather than as employees. For example, as we'll discover, it is easier, not easy, but easier, to have expenses incurred by those who are deemed to be self-employed to be allowable for taxation, i.e. an allowable deduction against income, as compared to being an employee. When we looked at the self-employed, we saw that for expenses to be allowable deductions against the trading income, they need only be incurred wholly and exclusively for the purpose of the trade, wholly and exclusively. Whereas when, as we'll see in a moment later on in the next section, section 3, and thereafter, in terms of expenses being allowable for the employee, then you have to satisfy 3 rules. You've got to have those expenses being incurred not just wholly and exclusively for the purpose of the employment, but they must also be incurred necessarily for the performance of the duties of employment. So 1, if you're self-employed, it is easier to get more allowable expenses to reduce the income of that individual. What we'll also see in a slightly later chapter, chapter 11 I think it is that in relation to either your employment income or self-employment income, then in addition to income tax, there's another taxation to be charged, which you may recall from our introduction to F6 UK taxation, known as national insurance contributions. And as we'll see in that chapter, the level of contributions, the amount you actually pay as a self-employed taxpayer, is likely to be lower than it would be if you were an employee. So there are good reasons why an individual might wish to be deemed to be self-employed. That is why the HMRC will look very carefully at this particular area and apply the following tests in terms of, well, actually, if there is no contract of service, these particular issues would again give the perception that the individual is in fact in employment rather than self-employment. Now, what I'd like you to do, there's no point me reading them to you, is to review through those for yourself. Again, it's the sort of situation which could be tested either in written form or in an objective testing question, where you might get, say, 4 issues mentioned, maybe 3 of those on the list of what you see beneath here in section 2.2, and you've got to pick out the one that is not going to be a test in terms of employment, and therefore representing a contract of service. So review through those, and you'll see exercises then later on in our studies pertaining to them. That allows us now to move on, and here in section 3, look at, to begin with, what we'll actually deem to be employment income, or as we refer to it as, assessable emoluments here. Now again, for most taxpayers, their employment income is a very, very simple issue. It is their wage that they are paid each week, or the salary that they are paid each month. And that employment income will be the cash amounts paid to them as wages or salaries. But there are other things that will go in determining the assessable emoluments. You may be lucky enough, depending on the type of employment you have, maybe you are a salesman, for example, salesperson, and you receive commission on sales. Or possibly indeed employees share in the benefit of the profits of the employer and are paid bonuses by reference to how well the employer has done in terms of its profits for any accounting period for which the business, usually a company, has traded. So other cash payments made other than salaries or wages may be a bonus, may be a commission. Now what we'll see in terms of those cash payments is the basis of assessment, and there is obviously one logical basis by which we'll assess, and that is on the amount of emoluments received in the tax year. So it doesn't matter what was earned, what matters is what was received. Now normally these would be one and the same things in terms of your wage or salary. But a bonus may be awarded in relation to an employer's year end that is very different to the tax year in which the bonus, or indeed the commission, was received. So what we look at is the amount that was received. The period to which the payment relates does not matter. What matters is when was it received. For us, of course, we're dealing with our 2015-16 tax year. We will look at what was received between the 6th of April 15 and the 5th of April 16. But there's one further issue. Again, it couldn't be that simple, could it? But the date received, you might think that that is very obvious. When it was paid to you, when you picked it up in your pay packet, when it is credited to your bank account. But that date received is taken as the earlier of the date when the employee, now here's a new term coming through to us, when the employee became entitled to the payment, or indeed what we'd normally expect it to be, the date when it was actually received by the employee. Now don't worry about the determination of that date when you become entitled. You will be told that very specifically. There are more problems there that attach in reality to what we may mean by the date when it becomes entitled. But it's not a problem for us at F6. You be told the taxpayer became entitled on this date, received on that date. And what you're looking for, of course, is the situation where one of those dates is maybe before the 6th of April 15 and another of the dates is after the 6th of April 15, in knowing whether or not it goes into the 15-16 tax year. Well, as we've just seen, the date received is taken as the earlier of the date when the employee became entitled. So, became entitled or when you received it. So if, for example, the employee became entitled to a payment, maybe a bonus payment from the employer, became entitled in March 2016, but didn't actually receive it until April 2016, let us say from the 6th of April onwards, say the end of April 2016, then we need to know if you became entitled in March 2016, but it was not actually received until the 6th of April 16 or after, let's say the 30th of April, in which tax year will you actually assess that bonus? Well, we look at the earlier of the date when you became entitled, that is March 2016, as compared to the date when it was received, say the 30th of April 16. Now, which tax year, therefore, does that earlier date fall into? Well, you became entitled in March 2016, that is in the 15-16 tax year. So although it was not actually received until the 16-17 tax year, the 30th of April 16 is in the 16-17 tax year, the fact that you became entitled to this payment in March of 2016 allocates it to the 15-16 tax year. So when you now are required to prepare the income tax computation for the 2015-16 tax year, you will indeed include that bonus payment. It does not matter when it related to. All that matters is when it is received, and when it is received is based on the earlier of those two dates. The date you became entitled to the payment, those words will specifically be used in your question, or when it was indeed actually received in cash by the employee. So, in terms of cash payments, wages, salaries, bonus, commissions, there we've got this basis of when it is received. But possibly most of the work that you may have to do in terms of a big written question, here in section C, you may see this on your exam paper, is working what are known as the various assessable benefits. There's a whole range of ways by which if the employer is so inclined that the employer may remunerate their employee other than in means of just cash payments, providing them with benefits. Now you just think for one moment, if you had the ability to write your own employment contract there in terms of the benefits that you will derive, the payments that you will receive, what else would you want other than a great big salary and no doubt a very good bonus scheme as well? There's various other benefits that may be provided to you by the employer. For example, you might be provided with the use of a company car. So you've got the use of a company car, and the running expenses, including the fuel, are paid for also by the employer. You may benefit from a company house, a property. Living accommodation is provided to you, an apartment, flat, house, whatever it might be. And not only do they provide you, the employee, with that accommodation, they also furnish it for you. You've got carpets, you've got furniture, you've got a TV set there. You've got all sorts of furniture and furnishings provided to you within that living accommodation. So there's a range of various benefits that may be provided to you. The vast majority of the substantive benefits that may be provided to you, like the ones that I've just mentioned there, the company car, the fuel for the car, living accommodation, other assets like furniture and furnishings made available for private use, all of these are assessable benefits. There are in fact some, it's actually surprisingly you might think, quite a long list of benefits that are exempt from assessment as employment income. Though the list is quite long, there are many of them that usually amount to very large sums. But indeed, we need to be aware of the whole range of benefits, those that are exempt, those that are assessable, and of course, where they are assessable, how do you work out the assessable benefit? For many, it will be very obvious. It will be simply the amount that you have received. It might be that the effective benefit, they pay for goods for you to have. They pay a subscription for you to be a member of a health club, a gymnasium or something like that. So the cost to the employer is the amount paid by them, that is the amount of the assessable benefit. But there are many benefits, like the car, like the fuel, like the living accommodation, like those other assets made available for private use, where there are specific rules. Rules that you have to learn and you will indeed be tested on within your examination. Okay, going over the page, we said that, it's actually section 4 here, not section 2, but in section 4, that there will be certain expenses that will be deductible specifically from employment income. Now, I've already given you the generic rule that deems whether or not such expenses are allowable, and it's this one mentioned here, the penultimate point. For expenses to be allowable against employment income, they have to satisfy 3 basic rules. They have to be incurred wholly, exclusively, and necessarily in the performance of the duties of employment. Now, what we'll discover is that there are certain specific expenses that we would be on the lookout for that will indeed satisfy those rules and will be allowable. But the generic rule must be incurred wholly, exclusively, and necessarily in the performance of the duties of employment. Now, specific ones to look out for in terms of deductibility of expenses. Expenses therefore incurred by the individual in that employment, in the performance of the duties of employment, that will be allowable. Again, very specifically, contributions made by the employee to an approved occupational pension scheme. When it comes to tax relief and tax efficiency, there's nothing better than pension contributions. That now, if an employee makes a contribution into an approved occupational pension scheme, that will be an allowable deduction from their employment income. Now, note here, because we've mentioned pension schemes before, the very specific name: occupational pension scheme contributions. What we have been used to from Chapter 2 is payments made by an employee into a personal pension scheme. And any such contributions made into a personal pension scheme do not feature as deductible expenses in deriving any specific source of income of the taxpayer. They are dealt with separately in relation to the income tax computation. They do not show as deductions. But here, and hence why it's vital when you read about a contribution made by the individual, by the taxpayer, into a pension scheme, you need to know primarily, firstly, what type of pension scheme is it? Is it a personal pension scheme, in which case you deal with, as we saw in Chapter 2, or is it a contribution into an approved occupational pension scheme, in which case it's very much easier to deal with because it's just an allowable deduction against the employment income, an allowable deduction against the employment income. And this therefore will serve to reduce the income on the face of the income tax computation, to be precise, the amount of net employment income to include as your employment income assessment. What else will we be able to deduct in terms of contributions, payments made, expenses incurred? Fees and subscriptions to relevant professional bodies. That is relevant to the job that you do. One day, indeed, if not already, you will be working as an accountant. And when you are qualified, hopefully in the none too distant future, you will pay an annual subscription to the ACCA for the benefits indeed of enjoying membership of that body. And the subscription that you pay will be an allowable deduction against your employment income if you are indeed working as an employee, working as an accountant, performing an accounting role. So fees and subscriptions to relevant professional bodies. Relevant, that is, to the work, to the employment that you have, the work that you do. What we also saw in Chapter 2, as well as contributions being made to personal pension schemes, where we saw how to deal with the tax relief available, both simply at the basic rate and then at maybe higher and additional rates of tax. We also saw that, treated in a very similar way, were payments made into charity under the gift aid scheme. payments to charity under the gift aid scheme. Well, what we now see is payments being made to charity by employees under a so-called payroll deduction scheme. Now, this is only available where employers operate a payroll deduction scheme, allowing the employer, this is the employee allowing the employer, to deduct directly from their gross salary an amount of that salary that the employee will determine, that is then to be paid over directly by the employer to a specific approved charity or charities as chosen by the employee. Now, this again is a far simpler way of dealing with charitable contributions made by an employee, made by an individual, as compared to the gift aid scheme. Here, all you do is any such payments made under the payroll deduction scheme are allowable deductions from employment income. So if, for example, we started off with an annual salary received in the tax year of £20,000 as your basic employment income, and you were then told that the individual paid £2,000 into their occupational pension scheme, and they paid £500 as a payment to a charity under the payroll deduction scheme, then the employment income assessment would be computed as salary £20,000 less the contribution to the occupational pension scheme £2,000 less the payment to charity under payroll deduction scheme £500. Take the two away and you'd have net employment of £17,500. So you'd have salary £20,000 less pension contribution, occupational pension scheme contribution, again I further remind you of, £2,000 less contribution to charity under payroll deduction scheme £500, take away the £500. If those payments had been under personal pension schemes or had been through the gift aid scheme, then a very different treatment would have applied. There'd be no deductions from the salary, the employment income would be £20,000, and instead those payments would be deemed to have been made net of basic rate relief at source, and the gross amounts would then have been available to extend the basic rate band and, if necessary, the higher rate bands of tax there. Now that again means go back, revise what we did in Chapter 2, re-personal pension contributions and re-gift aid payments. Here, in terms of employment income, far, far easier. Any contribution made to an occupational pension scheme, any contribution to charity under the payroll deduction scheme, they're made, they're paid gross, and they are deducted gross from the employment income in deriving the net employment income to include as the assessment within the income tax computation. Far, far easier. What other expenses may we have? Travel expenses that are incurred necessarily in the performance of the duties of employment. Now be careful with travel expenses. What is not allowable, I repeat, what is not allowable is the expense that the employee incurs in going from home to work and back to home each day that they spend working. Simply going to and from work is not an allowable expense. That is not one that's incurred in the performance of the duties of employment. That is what you have to incur to get you into work to then perform those duties of employment. The sort of travel expense that would be allowable is where you go, say, from work to visit a client, where you go out to visit a client, the customer there, again to have a client meeting, a customer meeting, a meeting with a supplier, where you go effectively from one place of business to another. That, if you incur the expense yourself, would be an allowable travel expense. Now, as we'll discover in a moment, it would be usual if you go out on company work and incur travel expenses, that those travel expenses would in some way, shape or form be reimbursed to you by the employer. It is seldom, that you'd have to make a payment out of your own pocket when you have to travel to visit a client, to visit a customer, to visit a supplier there. Now, how we deal with those payments and indeed then the reimbursement of them, we will see again as we go through the next section of these notes. But if you were left paying such travel expenses there, then those, if not reimbursed by the employer, would indeed be allowable deductions from your employment income assessment. Now, those are your main examples. Again, remember the generic rule: for an expense incurred by an employee to be an allowable deduction against their employment income, they must be incurred wholly, exclusively, and necessarily in the performance of the duties of employment. Another possibility, remote though it may be, capital allowances are in fact available for plant and machinery provided by the employee for the performance of his duties of employment. Now again, one would reasonably expect that for an employee to perform his or her duties of employment, that they need certain items of plant or machinery, that would be provided by the employer, in which case there'd be no assessable benefit, and of course there would equally be no allowable deduction for the employee. But in the rare circumstance where, to perform his or her duties, the employee must buy their own plant and machinery, equipment there to use in that employment, then any such payments made for plant and machinery would qualify for capital allowances. But that has got to be a rarity. Right. We mentioned there a moment ago travel expenses. Now, of course, that could be very specific travel expenses, that you travel by train or you catch a flight, and therefore those expenses are likely then to be reimbursed by the employer. What happens is, if they are paid for by the employer, they are firstly included within your employment income assessment. So if you've got a salary of $20,000 and the company, your employer, has paid travel expenses on your behalf, flight costs, travel on train costs, bus costs, etc., of say £2,000, then that will be included as part of the employment income. That then would form the basis of an allowable deduction against that employment income, that when paid for by the employer, they have been incurred wholly, exclusively, and necessarily in the performance of the duties of employment, so exactly the same sums come out as allowable deductions. Now again, you may think it's a bit of a worthless exercise, including as employment income and then taking out. Well, at least for the moment anyway, for our tax year, that is what we must be seen to do. Again, it will make no difference to the amount of employment income assessment. We include and then we take out as allowable deductions any such expense for travel expenses incurred. But where you may have rather more interesting work to do on a travel expense is maybe where you use your own car for business purposes. And what there are then, when you use your own car for business purposes, are approved mileage allowances that may be paid to you as recompense to you from your employer for the use of your own car. And if you are paid at these rates, then there will be no assessable benefit, nor would there be any basis for an allowable expense incurred by you. Now, what are these figures? For 2015-16, the approved mileage allowance will be 45 pence per mile for the first 10,000 business miles that you, the employee, do, and anything thereafter will be 25 pence per mile. Now, those figures are in fact provided to you on your rates and allowances page. Again, reference that, looking them up on your rates and allowances page at the start of these course notes. That will be given to you in the examination room. But when you get an exam question where the employee has indeed used their own car and they are reimbursed, as you'd expect them to be reimbursed by their employer, then the reimbursements will not be exactly the same as the approved mileage allowances. So what is the exercise that we have to perform as a working to determine either any employment income assessment or indeed maybe any allowable deduction from employment income is to compare, based on the level of business mileage given in the question, what would be the approved mileage allowance as compared to the payments actually made by the employer to the employee. So, employees who use their own car, I stress this is their own car, for business mileage, remember business mileage going from one place of work to another, not going from home to work and back. That is not business mileage, that is private mileage. But who use their own car for business mileage use the approved mileage allowances in order to calculate any taxable benefit arising from the mileage allowances received from their employer, i.e. they are other than the approved rates of 45 pence per mile for the first 10,000 miles and 25 pence per mile thereafter. Now if the amount here, so employees who use their motor cars for business mileage without being reimbursed by their employer, or where the reimbursement is less than the approved mileage allowance, then we can use the approved mileage allowance as a basis for an allowable deduction. So it's a simple calculation. You will be given the business mileage and you will be told how much the employee has been reimbursed by their employer. We compare that actual amount paid to the employee, the reimbursement there for the business mileage, we compare that with the approved, these authorised mileage allowance rates, the authorised mileage allowance payments there. Now, if you have been reimbursed more than the approved rates by your employer, there is an assessable benefit. That's an employment income assessment. If the amount that you have been reimbursed is less than the approved mileage allowance rates, then that difference forms the basis of an allowable deduction against your employment income assessment. Now we have here, thankfully, example 1 to illustrate the calculations that you would have to do. Right, Kerry uses her own car. You're told what the CC is here, but that will not have relevance where it's her own car that is being used. If again she were to be provided with a company car, then the CC will be important to you in terms of the emissions that might then be produced by that car. But that awaits us in a few minutes' time when we look at the assessable benefits of the provision of a company car. But here what we're interested in is that during our tax year she drove 12,000 miles in the performance of her duties, business miles. Now be careful in exam question. You may be told the total mileage and given an analysis of that total mileage. You then have to work out from that analysis what is actually business miles, i.e. from one place of work to another, as compared to what is private. And remember, as we'll say it again, private is to include the mileage from home to work and work to home again there at the end of the day. That is private. Here, however, we're told quite clearly the amount of business miles, 12,000 miles in the performance of her duties of employment. So what do? Right, we will work out what the actual amount paid to the employee is, that being given there at a rate of, her employer pays her 30 pence per mile, and we'll compare it with the approved, the authorised mileage rates. So let's do the approved, the authorised amount first of all. So using your authorised mileage allowance payments levels, 45 pence per mile for the first 10,000, 25 pence per mile thereafter. Work out for me please what that will be. Again, you may pause this at this point in time if you so choose. It shouldn't take you very long to do it. Okay, so hopefully you therefore have determined that so far as the authorised levels are concerned, that will be the first 10,000 miles at 45 pence. Did you do any more than that? Yes, there were 12,000 miles, so that's a further 2,000 miles at the authorised rate of 25p. Multiply those figures out. 10,000 at 45p will be £4,500 there. 2,000 at 25p will be a further £500. So the authorised mileage allowance rates would have been an amount of £5,000 that could be paid to the employee without any assessable benefit arising. Now we compare with that what the actual payments were. Now the actual was that for the 12,000 miles, business miles, that were actually driven there, she's reimbursed at a rate of 30 pence per mile. 12,000 at 30p, well that will be, what, £3,600. Take that away from your 5,000 and we have a difference of £1,400. Now what will that difference represent in relation to the employment income assessment? The authorised rates would have allowed £5,000 to have been paid to the employee without any assessable benefit arising. But what she has only received is £3,600. So, as we were told here in Note C, employees who use their cars for business mileage without being reimbursed by their employer for where the reimbursement is less than the approved mileage, here it is less than the approved mileage, then using the approved mileage rates we can work out what is an allowable deduction. So here we have determined that there will be an allowable deduction that you will be able to deduct from the employment income assessment for your employee, here Kerry, for our 2015-16 tax year. We can deduct from the employment income an allowable deduction of £1,400 in determining the net employment income to be assessed. Whereas, if the reimbursement paid here had not been at 30 pence per mile, but let's say a more generous 50 pence per mile, then 12,000 at 50p would have been £6,000. That means that she would have received £1,000 more than the authorised mileage allowance payments would have permitted. So in which case, Kerry would now have an employment income assessment to add in deriving your employment income assessment. You'd add in £1,000 to any salary or wage paid to her. So here we have to always do this calculation comparing what is the approved level of reimbursement with the actual level of reimbursement, and whatever is the difference will feature in determining the employment income assessment. If, as in our first example, she was only reimbursed at 30p a mile, a £1,400 deduction would come away in determining the net employment income assessment of the taxpayer to include within her income tax computation. If, on the other hand, she'd been reimbursed at a rate of 50 pence per mile for all 12,000 miles, she'd have received £6,000, which is £1,000 more than the approved mileage allowance limits would have permitted, so she'd have £1,000 to include as employment income. Now again, check through that, make sure that you are happy with how the calculations have been performed, and then return to us. Okay, well, having looked at what allowable deductions may be permitted from the employment income assessment, we can now spend the rest of our time looking at how it is we work out that employment income assessment in the first place. Now that, as we said, would be a combination of actual cash payments, wages, salaries, commissions, bonuses. We work on a received basis, and we have to be aware that in rare circumstances, but may be tested in your exam, What we mean by receive is not simply the date that you actually received that payment, but if earlier, you would take the date when you became entitled to the payment. But other than that, it's then all about benefits. Those benefits that may be provided, other than just cash payments to you, those other benefits provided by your employer. And we need to know, are they actually assessable or are they exempt? And if they are assessable, how will they be charged to tax? How will you get a figure now to include as part of your employment income assessment? And what I'd like you to do, please, between now and next time is just look at the next section here, section 6 in chapter 9 of our notes, where you've got, as I said, quite an extensive list of exempt benefits there. I'd like you to read through that, review through that list, please. And what we'll do at the beginning of our next lecture together, I'll run through and we'll pick out issues pertaining to, well, maybe the more important ones of those. But you must be familiar with that list. So start that process before we talk again together in our next lecture.